Well, hello everyone, and thank you for joining us here today for our ALM and funding strategies webinar as we head into the last couple days of the third quarter of 2023. So I'm Andrew, this is Sean, and you may or may not notice that we are in a different setup here. So just this week, in fact, we moved into some new offices, only down 3 floors in our office building here in Boston. So familiar territory in some regard, but we have some settling in to do, but we're all very excited across the bank about this new modern space, and we're coming to you live here from our dedicated media room, where we have, we're very excited about. We can up the production quality a little bit, and we'll be able to do these types of webinars and also do some new and exciting things, hopefully that you'll be able to get some benefit from. So you can see the overview here. This is the plan for what we're going to talk about today. We have a good amount of ground to cover, some things at least we find interesting, and then we'll reserve some time for questions and answers at the end. So if you have anything that you see during the course of the presentation, or even if it's something that we didn't cover, feel free to submit it in the chat in the GoToWebinar. I will not be answering the questions of how many times I went to the wrong floor in the elevator banks. You can guess. So we'll do a poll question next time about what your guess is there. So before we jump into some of those topics that we looked at, a couple things happening around the bank, non-office related here. You may have recalled a email about a month or so ago from Anna Dyer, our Chief Business Officer, about a change in our pricing policies. So just to walk you through an example here. So if we look at 3 different scenarios. So one, the old pricing, where we're assuming a hypothetical 5% cost of funds, and at that time, the term really doesn't matter here, we would apply a 25 basis point spread. So assuming we're talking about the same point of the yield curve and unchanged rates, now, if you were to borrow at that same term and product, it would be 2 basis points lower if it were to be in the afternoon. On top of that, we're also offering a time of day discount that if you do borrow before noon on any given day, assuming all else equal in these examples, the spread would be 20 basis points. So compared to the old version versus borrowing in the morning today, you're 5 basis points tighter than we were. So we're excited to be able to sharpen our pricing in that regard. And if you combine that with, we still offer further discount opportunities, whether it's the Tuesday, Thursday short-term markdowns or the advanced renewal discount program, that gives you an opportunity to shave a few more basis points off the rate. And then we can never forget about the dividend. Last quarter paid north of 8%. So when you factor that in, you're getting somewhere in the neighborhood of
25 basis points.
25 basis points for that all-in rate. On the event calendar, we have some exciting things that we're looking forward to. You should within the next week or so see an email come out where we're excited to be hosting representatives from Colliers, the commercial real estate firm, and they're going to provide us an update about what's happening in that market. And certainly there's a lot of eyeballs and attention there, and there's a lot of relevance, obviously, to the depository balance sheet world. So we're very excited for them to come in and give us an update about what's happening there. In the beginning of November, we'll be having our very popular CEO CFO roundtable event at the Newton Marriott in Newton, Massachusetts. So check your emails there. That is a great opportunity to get together with peers and share some ideas and network. And then in the middle of November, you're stuck with Sean and I again for another webinar where we'll have the data from third quarter call reports. And as we usually do, we take a deep dive into what's happening there and some trends that we can suss out and some ideas to navigate going forward. So let's dive in. We'll talk about economic considerations very briefly, but it all comes down to talking about the Fed. A couple weeks ago, the Fed paused. It did not raise rates, and so they've been on this pause, hike, pause cadence. And but they did update their dot plot, their forward expectations for where they see rates going forward. And what's interesting, the end of 2023 number did not change, but we did see changes in the 24 and the 25 forecast, increases of 50 basis points. And I'm sure many of you are sick of hearing higher for longer really come into the lexicon over the last few months. So, just generally speaking, the market, so whether it's the yield curve and the bond market, tends to be see the world in a glass half empty lens, and tends to be more bearish than the Fed in terms of where they see future rates. But that presents challenges because the steeper the expected decline, the more potential pain that they may be for the economy if and when things shift. But the yield curve has been inverted for a good period of time now, and and we said this before, it's been awfully painful to be early on that call about, well, the Fed isn't going to raise rates. I was working on a separate presentation the other day where I was dug into a webinar that we did a year ago, and when rates were at 2 or 3%, there wasn't the expectations that we're going to be into the mid fives on short-term rates. So, not really a component or a proponent of making bets in terms of interest rates. I think it's good to have a conviction when you're charged with managing a balance sheet. But it's less about what you think will happen, but you really have to factor in where are the pain points for our balance sheet and for our income statement going forward. And it's not necessarily the ideas and the strategies that maximize the upside, but it's really the ones that minimize the downside and that outsize exposure, like we said, the pain points may be. So when we think about economic indicators, inflation, as we talked about, is continues to be front and center. As we talked about things we're sick of hearing of, it reminds me of transitory, right? Remember that was the buzzword going back a year and a half or so ago. But this is one of my soapbox issues. So grant me, please, 30, 60 seconds to rant a little bit about this. You've seen a lot of things about the headline number coming down into the, back into the 4% range, even despite last month was a little bit higher than expectations. The year-over-year change works great when things move in a normalized fashion. But when we see that big jump, as outlined by the green line here, which is the CPI index, not the change, the pure index, we see that big jump in 2022. So the year-over-year changes are being judged off of an elevated level. So even if we do over the next months and quarters get back to a 2% target level, well, we're still off that long-term trend line, and there's two ways that we can get back to the trend line, and they're not really great options. One of them is we'd have to be negative for a period of time. Well, then that's where we're talking about recessionary type situations, and ironically, it's almost kind of what we're seeing in a way with deposits, right? Deposits grew so much in 2020 and 21, and now we're seeing declines really that we haven't seen, forget a generation, but really ever, right? So that's one way that we can get normalized. And I don't think anybody wants to see us be, consecutive quarters of negative CPI changes. The other way is that it takes time, right? We'd have to see 1.5% for a sustained period of time in order for that trend line to catch up to where the index may be. So to that question in the big green letters up top, is the fight against inflation almost over? Put me in the camp of saying no, it's probably not. So that's going to segue into Sean's going to give us some big picture thoughts on the depository balance sheet landscape.
Yeah, thanks, Andrew. So you mentioned obviously the sort of historically unprecedented level of deposit changes that we've seen over the past couple of years. Here's a slide identifying just over this 2-year time frame what has happened to deposits. And you can see in late 2021 and early 2022, we still had some of that deposit growth. And then pretty much right after the first Fed hike happened way back in March 2022, you started to see declines. And there's 2 periods of really very significant declines. Last fall, September, October kind of time frame, and then in the spring bank run period back in March and April. where we really saw steep declines. I guess the good news is on some of the deposit front here is that in the last 5+ months, deposits haven't actually gone down quite as aggressively. It's really those two big timeframes where we saw the big changes. And then, what's behind that? If you notice, these two curves, this is the Fed balance sheet on this page. Prior slide, this is just bank deposits. Boy, those curves look a lot alike, actually, don't you think? With one notable exception there, it's that peak going up in March in the spring bank runs. And what's happening there was the BTFP, the introduction of the BTFP, the Bank Term Funding Program, that I know some folks out there are using. And, that is up to about $110 billion right now. So that was a big part of that chunk on that sudden increase to the Fed balance sheet. Since that time, however, the declines in the Fed balance sheet have resumed. So it's kind of interesting about what's really driving that. And the big single driver on that is the reverse repo facility. What the heck is the reverse repo facility? GSEs like us at the FHLB and Fannie and Freddie don't actually get paid interest on their Federal Reserve accounts and actually aren't allowed to go negative during the day. And so there's this mechanism that the Fed's created called the reverse repo facility, where it allows you to put funds into that and then earn interest on that through this other mechanism, different from what other depositories experience with IORB. At any rate, those balances have been running out. The other big user of that reverse repo are money market mutual funds, also put money into that. And so as they've been able to invest more and as they've gotten more funds and as GSEs have found other alternatives as well, you've seen those balances run out. And so the Fed balance sheet has really started to decline. This chart says, let's take that noise out around the reverse repo. Let's just take a look at what sort of the overall balance sheet of the Fed is relative to bank deposits, again, over this sort of tightening time frame. And what you see here is this pretty tight correlation between the two. And in fact, if you do the math on it, the correlation here, the R squared is basically 55. So more than half of the balances in one of these metrics can be explained by the other statistically. So you could reasonably argue that more than half the change in bank deposits is really being affected by the quantitative tightening that the Fed has pursued. And then again, if you look at this most recent 5 months or so, the quantitative tightening has slowed. It isn't what it was back in 2022. And I think that's the primary reason that we've seen this bank deposit outflow kind of pause. It's not as bad as it was. We're still not seeing growth, but it's not that same level of mid to upper single digit deposit declines that we've seen prior to that. All right, so how have our members fared? Here's to take a look at what the range of outcomes has been for both banks and credit unions here, members at FHLB Boston. And these histograms are taking a look at bucketing it by 5 percentage points buckets. So that top bucket on the left-hand side, the member banks, 0 to -5%. We've had 50 different member banks that have had deposit growth year over year of 0 to -5%. And you can see the ranges for everything else. If you're to the left of that sort of green line in the middle, that's a negative. Credit union, similar story. We've seen also an even 50 members who've had 0 to -5% deposit growth over this time frame. And again, what you see in a lot of our metrics is that banks are a little bit more than on all of these. Whatever the number is, the bank has a bigger variance in the credit union world. And so we've seen over 60% of member banks have year-over-year declines, 55% of member credit unions. On a mean basis, actually, credit unions are slightly up. So we've seen outsized on some of the bigger ones. And then on the bank basis, it's most people are experiencing declines, and very few have particularly strong performance in this time frame. And so the other thing to think about here that Andrew was alluding to is what's going on macroeconomically. How are things faring in the world generally? We see deposits declining. Is that causing effects in the world of credit and lending? So we have seen, and a little bit of a surprise to me, still a lot of lending out there. But most recently, we came out with the SLOOS, the Senior Loan Officer Survey, that came out a month ago or so. And that particular survey shows that it asks senior lenders at mostly larger institutions, what are you thinking about credit standards? Are you tightening credit? Are you extending loans? What are you doing? And so this top graph takes a look at the world of C&I, our credit standards tightening for C&I loans. And what you see here is we're approaching levels that are very similar to past recessions. The bottom slide is taking a look at CRE and construction, and there's not as long a data horizon on that one. But again, you can see that that's probably approaching levels that are likely to be recessionary. The vast majority of respondents to the survey are saying yeah, they're tightening credit standards and they're being a lot more selective on the lending side. And so that's something else to kind of think about as we go forward here is when does lending really slow as an industry?
Well, thank you, Sean. So let's talk about what's happening for deposits that the type of deposits that are actually making their way onto the balance sheet. And should be no surprise to anyone here on this call, given the conversations that we have all day long, that deposits, the ones that are sticking around, are flowing from non-maturity deposits into certificates of deposits. So there's two things to consider. That one, the CD book in and of itself is shortening. And so here we're looking at the distribution. There's slight differences in terms of how the bank and the call reports break these things out. There's a little more granularity for the banks in terms of looking at less than 3 months and then 3 to 12 months, where the credit unions just call it less than 1 year. So we have seen, generally speaking, a shortening of the CD book, and that makes sense. And we'll talk a little bit about the types of offerings that we see folks using out there. Frankly, when I was pulling this data, surprising to see about 30% longer than 1 year for both banks and credit unions. Especially, one, the multi-decade shift away from CDs that is occurring. There's the tired joke that most young people don't even know what CDs are, whether it's deposits or listening to music. But especially it stood out a little bit because of where we have been in terms of the path of interest rates, right? Rates were so low in 2020 and 21 that, a 3-year CD at 50 basis points probably wasn't moving the needle for many depositors. So, the impact of the shortening within the CD book, but also the transition from non-maturity deposits into CDs, it's become an asset liability management interest rate risk story. Your non-maturity deposits, somewhere between 3 to 7 years in average life, generally speaking. And then if they're flowing into CDs with less than a year, well, your duration is that much shorter. And combine that with the asset extension from rising rates that has contributed. We've heard from many folks that said, we used to be comfortably asset sensitive, now we're neutral. We used to be neutral, now we're liability sensitive. We've seen that with our activity levels, and then we have seen more and more longer term borrowings from folks who maybe historically that hasn't been the case, because they have the need, not just on the liquidity side, but also the motivation to mitigate interest rate risk. So when we look at the shape of the yield curve, we talked a little bit before about the inversion in the belly. But when we look at posted CD rates that we have across the district here, it's very clear to see when we break it out by the percentiles, the quartiles, that the common strategies are not leaning on the posted rates, using more odd term special that don't necessarily flow into the clean data collection, and then also playing more defense than offense in terms of waiting to respond to customers who come in and say, I need a higher rate, or else I'm going to the institution across the street. So the 75th percentile CD rate for all our members at these various terms is somewhere between around 200 basis points less than advances. I wonder if you're bringing funds in at those levels. If you are, congratulations. From what we hear and can tell, you're probably not the case. When we look at the maximum CD rate at these various terms, they're right on top or even north of advance rates in many cases. And I think when you think about the fact that factor in the dividend, factor in the fact that maybe the customer who is that rate sensitive is probably not it's not the stickiest funds around, that you really have to have a pretty good set of reasons to justify, especially in this environment of margin pressure, to paying above readily available wholesale rates to bring in deposits. So as a good rule of thumb, we tend to see that 50 to 100 basis points below advance rates is a good target rate for CD offerings. Now, the follow-up question to that is, Andrew, I can't raise deposits at 450. which would be that 50 to 70, 100 basis points. Well, then I think there's your answer there, right? Because you want some interest rate risk mitigation, you want some ability to earn NIM as you go out and deploy that funding on the asset side. It may be better, especially as we get into cannibalization and marginal cost of funds, to hold the line and then just look to strategically backfill with advances. So, what can we practically, this is all well and good, but what can we practically do? So, I've been a proponent for a little bit that, it might be a better time than it has been really in a generation to test the waters on longer CDs. Now, I know, most customers, they're going to gravitate towards the short end, but you haven't been able to get 4 or 5% rates in a bank deposit or credit union deposit product in a long time. And there's also the potential for differentiation because we see and hear a lot of those 475 for only 5 months. So if you're going out there and saying, well, we're willing to give you a higher rate for a longer period of time, maybe that resonates. And like we showed 2 slides before, there are folks out there who have appetite for longer CDs, right? 30% of the CD book. But so when you think about, well, I don't want to get stuck with paying 4% for 2 years. Well, funding exists to be able to do things on the asset side of the balance sheet. So if you're able to bring in 18, 24-month CDs, well, maybe that affords you the ability to go a little bit longer, take advantage of some of those higher yields in the lending book or in the investment world, and maybe even some term premium that you can extract in terms of wider spreads. So naturally extending your funding gives you more capacity to take some of that incremental interest rate risk. We won't belabor the point on marginal cost of funds and cannibalization. I'm sure everybody at this point in the cycle knows all about it, but I would just reiterate that you should be tracking it and knowing exactly what the true cost of that money may be. I think this is the environment for non-traditional features, right? We all strive to not have customers who are solely looking and being 100% rate sensitive. So whatever features that you think may move the needle with your client base, to get the conversation solely away from just the rate. Now, especially given as Sean showed, even with the plateauing, just the lack of growth and the liquidity metrics, that now's the time to really look at all the options on the table. And then the last bullet point here on the deposit side is leaning more into CDs creates this situation that we haven't had to deal with it for a long time. It creates some chunkiness and choppiness in the cash flows of the liability side. So if you had a CD campaign that aggregates all the activity into one particular month, for example, say 7 months from now, well then that creates a potential liquidity, not situation, but just something that you need to address because you don't normally get those chunky cash flows from a non-maturity deposit reliant deposit base. So one thing that we've had a lot of conversation with folks and we've seen people put into practice is the forward starting advance, where rather than say, okay, well, if I have $100 million of a CD campaign coming due in 6 months from now, rather than wait and take that interest rate risk and then get into a food fight for versus every institution in our geography about where we'd have to pay market rates to keep that money, maybe take advantage of the inverted yield curve right now and look to, I don't know if there's a word, but pre-replace some of that funding with the advances, right? And maybe do a portion of it, because to say you have 50 million coming off and you do 20 million of a forward starting advance, well then now of that 50 million of the CDs coming due, you've replaced 20, you only have to fill the bucket on 30. You can be that much more aggressive on the pricing, and maybe you'll get surprised, right? And then, now you're in a better position cost of funding wise.
Thanks. So, a lot of different opportunities out there, obviously, as Andrew's talking about with deposit sizes. But I think a kind of a big fundamental question for a lot of folks out there to answer in this environment that is so tough, where you are pulling all the levers, you're trying to think about all the different ideas for raising funds, and growth is such a challenge. Is this an environment to shrink? Is this an environment to actually just kind of hold hold serve. And so it makes me think of Alice in Wonderland here, where I think when she drinks this potion, she shrinks. I think if she eats a cake, she grows, something like that. Andrew said we weren't going to do cute little stories here, so I'll limit this to just this cartoon. But I do think it's an honest question that I think a lot of folks might be thinking of themselves as Alice in this question, saying, should I drink this potion or not? And so I would offer kind of an idea of, or a rubric to try to think about, how do I make that assessment? How would I, if I were back as at a depository, thinking about just that question? We're entering budget season right now. Where should you grow? How should you think about it? What should we think about? And I would start the question with capital and say, you know, how do we look with respect to different capital ratios? And then move that into saying, how do we feel about liquidity? And none of these are one metric. They're all a combination of metrics, and we'll talk about that in a second. And then finally, kind of think about, you know, how profitable is different activity? If we do have capital, if we do feel good about liquidity, are the actual activities that we're pursuing more profitable? For instance, deposits, my gosh, they probably never look more profitable in the industry, or certainly not in a very, very long time, especially DDA accounts, extremely, extremely profitable right now. So how do we think about putting all these things together? And so one thing that I really want to highlight is this idea around excess capital. Sort of, you have a variety of different capital measures that everyone has to hit. And one or the other of the capital ratios is going to prove to be limiting to your institution, right? So in bank space, there's tier 1 leverage, tier 1 risk, CET1, the common equity tier 1, total risk, or you could just elect to kind of opt out and go the CBLR, the community bank leverage route. So which one of these is going to prove to be limiting to you? So if you do elect to use the CBLR, that's going to be the limiting ratio to you. But if you don't, then there's these other ratios that could all limit you. And so what this chart takes a look at is to say, whichever one of these is the most limiting ratio to you, what's the variance between that number and the well-capitalized minimum? And then you see the breakdown in the numbers below it to say which ratio has the most number of members that are limited by that ratio. And so what you find in the bank world is total capital is actually most likely to be the single most limiting ratio for banks. Kind of makes sense, because banks are going to do a lot more commercial loans at 100% risk-weighted asset levels versus the 50% for mortgage or the 20% for most investments. So I'm not surprised to see that most banks, or the total capital is the sort of mode capital ratio that's most likely to limit folks. But there are 53 banks out there of our members who are using CBLR, and then everyone else is on tier 1 leverage. And this also kind of highlights, you know, where's the bucket? How much capital is too much? There's kind of a Goldilocks level of capital, right? If you're too thinly capitalized, you're probably running risk really hot. And if you have a situation where there's credit problems someday, or lack of profitability combined with credit problems, combined with liquidity problems, you run a risk of an adverse event for sure. On the other hand, if you have a lot of capital, probably it's not as profitable as it could be, and there's an opportunity to do something with that capital that could enhance your institution one way or another. So where do folks shake out? And what you see here is that most folks shake out in this sort of 2 to 4% bucket and 4 to 6% bucket. Those are the two biggest ones on where people actually have as much excess capital. The mean number is 430, so a little over 4% on average, and the median's 3.5, meaning there are some places that are really, you know, really prize capital and keep a lot of capital. So a bit of a difference there between the mean and the median. Only a couple people right now, and that below 0% is CBLR folks who are just below the CBLR limit right now, and there's sort of a grace period. Just a note there. And then on the credit union side, what is the limiting ratio? A lot of credit unions are using Cooler, the credit union leverage ratio, basically the community credit union leverage ratio, similar to the CBLR at the 9% level. In fact, the lion's share of our credit unions are using that designation, and only 2 are limited by total capital, and everyone else is limited by that net worth, which is comparable to the tier 1 leverage in the bank side. One note of housekeeping here is that credit unions are actually on the net worth ratio have a 7% well-capitalized minimum versus banks at the 5% on tier 1 leverage, so it's a little bit of a higher standard. And what that means is that, again, if you kind of think about the way these work, banks have a generally higher level of excess compared to credit unions. You can kind of see how that chart shifts, the center of gravity shifts towards the left. And a lot of that is because a lot of the credit unions are electing the CBLR, which has a very high standard, and the net worth, which is inherently a higher standard than banks. The excess here is 2 and 1.5. So if you add back the 2 points, it's actually very, very similar on credit unions to banks in terms of the absolute level of rates, though the excess in credit unions isn't quite as strong. So how might this be really useful to you? Well, I would think, especially if I were a bank, I would think about which one of these ratios is limiting, and then how does it compare to the other ratios? So if you were in a situation where your total capital were, say, 11%, so that's not a huge buffer above the well-capitalized minimum at 10% and the 10.5% for sort of the places where compensation restrictions start to come in for folks. If you're at that place where there's a thinner level of capital, marginally a lower risk-weighted asset actually adds more profitability to the institution, not on a nominal basis, but on a risk-adjusted basis, on a capital use basis, because you're not stretching that risk-based capital. You're taking advantage of the differences between the leverage ratio and the total capital ratio. So in that case, an investment at a wide spread, very wide spreads these days, or a mortgage also at a very wide spread these days, that might be the better bet if you're kind of constrained on that total capital. And it's just the reverse. If you're more limited by the leverage ratio on a significant way versus the total capital ratio, then there might be an opportunity to go out on the risk spectrum in the credit world where you could get higher nominal rates and higher risk-adjusted rates. So understanding which one of these governs your institution and which one has better variance versus well-capitalized could be a real potential value unlock for folks out there. So we said we would take a look first at capital, and what we think about there is to say how much excess capital do we have, and do we feel good about what that level of capital is relative to the risks that we might see in this environment. And then the second piece is we said, hey, let's take a look at what the policy guidelines, what are risk guidelines, particularly liquidity risk guidelines that are happening at our institution. And like a lot of these things, it's not one metric. No one metric is telling the whole story. It's a combination of metrics together that work together that start to tell the story. I'm not going to go into too much depth on this particular slide or in this topic because in March I did go into a lot of depth on this. So I'd encourage folks to dig up that old webinar from March that really goes into how I would try to think about putting all these different metrics together and how you might holistically consider the value of different metrics. But what I'll quickly identify is as you start to assert targets or minimums on certain ratios, you are necessarily crowding into other targets and minimums on other ratios. So you've got to kind of be a little bit more global in the thinking around the balance sheet and how your institution is structured, and especially with your clientele type, whatever your client verticals are doing. So if you're a very commercial heavy institution, a lot of C&I, there's probably strains on borrowing capacity because that's not as pledgeable here or in other places, right? And vice versa. If there's a lot of real estate, maybe you can take advantage of wholesale funding a little bit more because that's really freely available to you. And that's the type of thinking that I would think about on liquidity ratios. I'd also highlight on this too, things like, loans to deposits ratio, wholesale funding ratios. We see where our members are here, banks again on the left and credit unions on the right. This is again to give kind of an idea about where are your peers? Where are other folks on these measures? And these box and whisker charts show the bottom of the box is the 25th percentile, the top of the box is the 75th percentile. The whiskers, the sort of the lines above it are sort of the full range, and then any dots are outliers in the data set. And what you see is that banks are around usually 90% on loans to deposits, and quite a number of banks are above 100%. And then in credit union world, that number is usually in the low 80s, not quite as high as banks. Again, in all these measures, when we take a look at everything, banks have a bigger range of variance often than credit unions. And then on wholesale funding use, wholesale funding use is significantly up in the past year, no surprise, as we've seen deposits kind of struggle. And in banks, what we see is that the mean is in sort of the low teens. A lot of folks are up to about 20%, some folks significantly higher. And in credit union world, it's sort of upper single digits. All right, so we said we were going to take a look at capital, then we would think about liquidity, and then the final question about, well, how profitable? How profitable are different assets and liabilities as we think about assessing growth? And so, on the investment side, I think what we know is that a lot of investments have historically wide spreads right now. Mortgage backs and mortgages themselves have kind of historically wide spreads. What might that translate into ROE, taking a swing at actually trying to estimate the profitability here? So on the left-hand side, I tried to take a quick estimate on, what are residential mortgages worth right now? What's the profitability? And so what that's saying is, let's take a rate, let's back out the option cost, the interest rate cost, a liquidity cost, get to a spread, assume something around operating, and then divide by a series of buildups on how much capital you might need against that and get to an ROE of about 11%. Your mileage may vary on how you do this and what assumptions you're using for that, but pretty profitable for a traditional mortgage compared to what you might otherwise see. And then on the commercial side, very similar numbers. Kind of came to some similar numbers there again on the ROE side, and thinking about how you might build up capital and how you might add value. So pretty profitable numbers here if you're booking, things in this kind of ballpark and thinking about what kind of risk you're assuming on that. One thing that I'll again highlight is that we talked about in past webinars is managing prepayment penalties on the commercial side is a really great way to add value right now. Just settling for a 5-4-3-2-1 when rates are elevated like this is a really tough kind of value proposition right now, I think. And if rates do decline at some point in the future, it's not going to look as profitable as you might think. So something to think about there.
Sean's favorite word, convexity.
Convexity. Always talking about that positive convexity. So, what are the final questions that we might ask ourselves here to assess growth? And it's sort of going down this list here and saying, should we build capital? Should we deploy capital? Should we kind of hold it serve? And if you do get to a place where you say, geez, my total is at 11%, I really want to build that up. I looked at the peer metrics. I did some math internally and said, geez, I need to get to 12 something, maybe 13. Where should we be? Well, your capital ratios can grow by ROA. So if your ROA is 80 basis points, then an 11% total capital ratio, all else equal, could probably go to about 1180 in a single year if you didn't grow. So that's another way to think about that, is that capital, again, it's like kind of turning around a battleship. It's really tough to move overnight unless you do something in the secondary market. Are we approaching risk limits? How are we looking on some of these risk limits, and how do we compare to some other folks out there? And are there things we could do to enhance borrowing capacity? I know a lot of folks out there have done so in the past year. We've seen a lot of activity on people pledging more, trying to find different asset classes. We think there's a lot more out there too. There are still some opportunities out there for a lot of members to pledge more assets and to enhance that borrowing capacity. So something else to think about. And does lending profitability justify using all of this? In this environment, maybe. If you feel good about the credit, it's always sort of the big caveat at the end. And then finally, another point to think about is the non-interest items. We talked here extensively about the ALM related issues and considerations, which again is sort of our world, but maybe it's non-interest items like offices, maybe it's headcount, maybe it's things like that you have to think about as we go forward. How do we fit into these strategies? Well, if you are thinking about shrinking, one thing that we've highlighted a few times and has become really popular in this environment, even though the world of mortgages is not quite what it was in the past, is the MPF program. This is where you sell loans directly to us. Instead of pledging them, you sell them directly to us, and you get paid income for actually assuming a portion of risk still along the way. We think this program is more attractive than it's been in a very long time. A lot of folks, I think, agree with us on that because we've seen a lot of signups and a lot more people using it. And so it's something to consider if you are thinking about shrinking and you are thinking about how do I find room in the balance sheet, think about the MPF program here. And then if you are thinking about growth, if you are looking at it and saying, my capital's fine, my liquidity's fine, you're right, I think loans are pretty profitable. Maybe you can augment with wholesale funding through us. And then think about sort of the interest rate risk to think about what advance sort of complements the risks. And that's a nice segue as we think about what type of advance would complement your risks, is to think about, should you float, should you extend, what should you use bullets, what type of product should be available, should you think about using? And so something I wanted to think about here was to say, hey, if you were going out for a few months, or you thought you might go out for a few months, which product might be better for you? Would it be doing bullets? Would it be thinking about a floating rate advance? We're at a point of major uncertainty. We've talked about it several times today. We don't know, nobody's completely sure. I don't think the Fed is completely sure whether the next move is a hike, if that hike is coming in November or December or next year, or if the next move is another hawkish pause, or the next move is a cut at some point. And so one of the questions to ask yourself here is which structure should work best for you. So if you were presented with this of saying, hey, you could do SOFR index advances at a spread of +21, or you could take a 1-month bullet at ranges in recent sort of experiences, which one should you borrow? Is there a very clear better or worse option? And so the way you might want to evaluate that is to sort of set the SOFR float and the SOFR bullet in like-kinded terms. So you're putting it both in SOFR terms, not just looking at it nominally. So on that upper box, we're taking a look at what the bullet is in SOFR terms. And what we find is the bullet's cheaper than the floater by a few basis points, apples to apples. But then if we do turn the tables around and say, okay, what does it look like on an absolute value basis? Well, it's a little different on that 3-month piece, where the SOFR index advance at 551 is cheaper than what the bullet. And so the point there is the market is baking in the possibility, but not the certainty, of potential Fed hikes. And so if you think there is no hike coming, there's not going to be a hike, then the floater is a really interesting option for folks out there right now compared to bullets, because even though the market's not fully baking in the hike, it is baking in a portion of it. And so if you want to bet against that, the floater is an option, and vice versa. If you think, my gosh, there is going to be another hike coming up, then the market is not fully pricing that in, and taking a bullet and extending a little bit is probably going to turn out to be the better bet on these sort of intermediate horizons, shorter intermediate horizons, precisely because the market's not baking it in. And so just like our last kind of questions, we said, hey, what is the questions to decide how you might act? And what I would offer here is, the first question is, how long are you going to go out? In this example, if it's very short term, you know, the bullet wins in both cases, both on an absolute and relative basis. But if you are going out longer term, then the key question is, what do you think is going to happen with the FOMC? So if you do think that the FOMC is going to hike, then bullets are probably better. And if you don't, then it's probably the floaters. And then another thing to think about with floaters relative to bullets is that the floater allows you to just sort of constantly keep that advance without having to do all the homework and all the administrative work.
Right.
And so if you just want to set it and forget it, an old 90s infomercial I remember, then you might want to think about the floater if you're used to rolling bullets, because you might miss that rollover one day. And then finally, you know, the SOFR index advance is a really great opportunity if you have a hedge strategy in place. It probably really significantly reduces the chances of hedge ineffectiveness because it is indexed to SOFR right there. So things to think about as you think about funding options.
Well, thank you, Sean. So let's talk about a couple advanced ideas. So, you know, one of the great things about, you know, our role in the universe here is that we get a chance to talk to a lot of folks in the banks and credit unions all across New England, and so we get a pretty good qualitative feel for you know what's going on and which way the wind's blowing. And one of the things that we've observed over the last call it month or two is that we've gotten more questions and inquiries about what kind of ideas should be on our radar, right? What other products that are we not thinking about? And I think that's a function of all the pressures that we've been talking about on the funding side, and as Sean said, budget season. So folks are starting to get a glimpse into what 2024 looks like, and it's going to be a challenge. So I think you know we have to kick every tire and see what's out there. So I'm going to go through 4 ideas here that I think make sense in this current environment and that present some value. So, you know, the HOV option advance is likely one, if you've been paying attention to our webinars and our daily communications, that's probably on your radar. So it's where you sell the option to the home loan bank in order to lower the rate. And you know, here we're just outlining some of the ways that the different structures can produce a lower rate. So generally speaking, the more optionality there is, you're going to get a greater discount. When you have a shorter lockout period, that period of guarantee before the no put decision occurs, that's again is going to produce more discount. Generally speaking, a longer state of maturity is going to lead to a higher option value, more of a discount. And then high interest rate volatility contributes as well. So it's important to understand if this is not something that you're familiar with, the cash flow profile, but more importantly, the potential change in the cash flow profile. And I would summarize it is that it's the liability version, the mirror version of what you're very familiar with in terms of a mortgage. So that contract, expand decision is the opposite of what you see in a mortgage. So it's a case where if rates go down, generally speaking, the advance would extend. If rates go up, generally the advance would contract. But remember, by taking that optionality, you're getting compensated for that cash flow potential variability. The SOFR flipper is one advance that has been increasing in popularity of late. And as we mentioned up here, it's a cousin to the HLB option because it is very similar in terms of selling that optionality, but with the added wrinkle of for the period of the lockout period, it's a floating rate as opposed to a fixed rate throughout. And also the floating rate comes with a discount to SOFR that is highly customizable. So you can select how much of a discount that you would want. So we have 3 examples here. SOFR minus 150, SOFR minus 250, and SOFR minus 500. And the greater the discount, the generally speaking, the higher the back end coupon would be. So you know, there's some dynamics here in terms of the higher for longer and the impact that if you're talking about starting advance rates in the 2s, 3s, or even in the case of structure C in the 0s, that depending on the direction of rates and the magnitude of any moves, that put decision may increase, and you'd be able to minimize a funding cost during that lockout period. So this is the advance. So switching to from selling options to buying options, that I think is really the idea that I think has a lot of merit in this environment. As the member option name tells us, that you own the option and you have the ability to shorten it. So here we're looking at a 10-year, 1-year structure. So 10-year maturity, 1 year of lockout with a one-time call option at the 1-year mark. And that was recently priced at 6.25. Now you're saying, why would I want 10-year funding and why would I want to pay 6%? And we'll get to that in the next slide here. So the reason why it's a consideration is because you get the value and the duration benefits of the long-term liability. So we won't go through all these numbers, but this is something that we're really going to put a lot of work into in the next couple of weeks. You should see some analytics and some articles and case studies to this point, but always feel free to reach out and we can run some numbers for you. Here you'd be looking at about a 7.5-year duration, and that affords you benefits in terms of your interest rate protection, how much it contributes to your EVE or your NEV calculations, right? Now, to get that same level of duration by taking classic advances, there's a multiplier effect. You'd have to, for $10 million of a long-term member option advance, you'd have to take 77 million of a 1-year or 39 million of a 2-year. And obviously with the higher principal amounts, that comes at a higher interest cost. And we're doing some of the comparisons here. So the summary down there at the bottom, with the same duration benefits, less borrowing required, right? So less strain on your borrowing capacity, and ultimately at a lower total cost. And again, because at the 1-year mark, you can prepay the advance, you know, you're not holding that advance for the long duration if you don't want to. So there's a lot here to unravel. I think, like we said, that you're going to be seeing more from us. I think that this, if interest rate risk mitigation is on your radar right now, then there's merits for this type of strategy. Symmetrical prepay advance, similar to the long-term classic, but the benefits are in a rising rate environment where the funding is below the marginal market cost. You can capture the favorable gain, and much like a bond that, well, there's not many gains in bonds right now, right? But sometimes when rates move in your favor and you have a bond, you have the ability to sell it and take a gain. Similar idea, but this is the liability version. To give you an example, just about a year ago, 5-year classics were at 403, symmetricals were just 2 basis points higher, which is typically where they are priced even today. As we went through the last year, as we talked about, the market underprices the probability of rates continuing to go higher and higher. Short-term rates went up pretty significantly, and even the intermediate part of the curve reacted to that higher for longer. And then as we sit here today, if you were to have taken out a classic 1 year ago, you could pay it back, but there's zero fee, but there's also zero credit. On the symmetrical, because you get that market value gain, you have the ability to get a 2.5% gain. So for $10 million, you pay back only 9.75, and you'd realize a $250,000 gain. Not bad. You can offset that maybe if you have some asset cash flows, large depositor come in, and you're, as Sean showed, deposits have kind of plateaued. So certainly there's some instances where maybe you have some less of a need for wholesale funding. So this would be a rather efficient way to do that. So taking a look here at the queue, and we have a question related to what we talked about in the beginning about the pricing changes. So just let's see, when did the FHLB start having sales and specials? And what are all these specials and when are they available? And did this occur in August or before? So a little history lesson. So we used to have more specials than we typically have right now. So aside from the tightening of spreads that we saw over the last month, if we rewind about a year and a half ago, we did narrow our spreads considerably as well. So, we're less reliant on saying, hey, we're having a special on this particular feature or this particular product in any given day. If you look at our rates relative to the Treasury curve or other benchmarks, you're going to see very, very narrow spreads. So it's been a concerted effort on our part to have low everyday pricing and not have members need to be calling the desk and saying, hey, I would love to see this particular structure. Can you run a special at some point later this week? That if you see something that you like, you know that you're getting a very competitive rate any day of the week. I'll elaborate on some of the discount offerings. We don't say specials anymore. That's like, put it in the swear jar. But discount opportunities would be on Tuesdays and Thursdays, short-term 1, 2, 3, and 6-month offerings are offered from 10 to 10:45, and you're able to shave a couple basis points off there as well. But then the advanced renewal discount program affords you the ability, when you have a maturing advance, if you replace that as it's coming due, there's a grid where you're able to save an additional few basis points by pre-replacing that. There's that word again, pre-replacing that advance before it comes due. So you can stack those on top of the low everyday pricing, as well as the time of day discounts that we were discussing earlier. So
I'll just really quickly add
that
our pricing has actually sharpened a lot. This is another one of those things. If you do look at it on a basis compared to other opportunities and options out there, I do think FHLB Boston's pricing has sharpened compared to what it was historically some years ago, for sure.
Yeah, so that brings us to the end. Thank you for bearing with us here. As we tend to do, we always go over. I think that's because in this environment, there's a lot to talk about, and we wouldn't wish it upon you, but we could probably go for 2-3 hours on this. But as we always say, we're easy to find. If there's anything that we can do and be of assistance to you and your organization, we are at the ready. Whether it's analytics, feedback, insights from what we're seeing and hearing, we're here to help you, the members. So thank you again. Appreciate your time, and hopefully we'll speak and see you all soon. Bye.